Welcome back, everyone. For those of you who are new to this channel is dedicated to all things personal finance related, helping you earn more, spend less, and invest the difference. So today we're going to be talking about what is shorting a stock. Now, typically when you are trying to invest in the stock market, you're trying to identify companies that are solid, that they are going to grow and earn profits. And it's the classic example of buy low, sell high. So let's say that you buy this particular company at $10 per share, and then at some point in the future, their value has gone up, and now they are valued at $15 per share. So you decide to sell your shares in this company, and then you would gain this price difference, that $5 price difference per share, and that's how you would make money. But shorting a stock is a way to make money when you think this particular company is going to do poorly as opposed to actually do well. Now you might be saying, how are you possibly going to make money if the company itself is going to do poorly? How do you make money in the stock market when everything is going down? And the way this works is that you're not actually buying the stock itself. You are simply borrowing it with a promise to later return it to its original owner. So this is all going to be handled through your brokerage account, Fidelity, Charles Schwab, Vanguard, whoever it is that you usually use to purchase stocks. You can usually set up these type of margin accounts to short a particular stock. So the way this works is, let's say that you think that this $10 company is actually going to do poorly. So you're going to contact your broker, and they are going to lend you. They're going to go out and find somebody willing to lend you one of those particular stocks. And then you are going to turn around, and that stock is going to immediately get sold. So like we said, it was valued at $10. You are going to then sell it for $10. Even though you didn't own this asset, you simply borrowed it from somebody else, you're able to sell it based on the promise that you made that you are going to, at some point in the future, return this stock to its original owner. Now, there are going to be some fees involved, so you're probably going to have to pay interest on this stock that you borrowed, and there's probably going to be some brokerage fees that are going to be involved as well. But the idea is that in the future, this particular stock is going to go down in value. So let's just say that this $10 stock that you borrowed and subsequently immediately sold now goes down in value to $7 per share. Well, in that case, you might go out and repurchase this stock for $7 and then return it to its original owner. So you borrowed it, sold it for $10, and bought it back for $7 and gave it back to the original owner. So in the process then, you made a $3 profit because you sold it for $10 and you bought it back for $7. Now, shorting a stock is risky because generally speaking, most companies do well. That's their entire purpose, right? Their entire purpose is to make money. So over the long run, most companies will increase in value. So inherently, it's a little bit risky to try to speculate that an individual company is actually going to do poorly. That's why over time, the stock market as a whole goes up in value. Shorting stocks can also be a little bit dangerous because while your returns are limited, theoretically your losses are unlimited. So what do I mean by that? So let's just say that we'll go back to our $10 per share stock, and in a best case scenario, if you are trying to short this stock, the price of the stock would go to zero, the company would go bankrupt, in which case you borrowed this stock at $10, you sold it, now you have $10 in your account, and then when the stock goes bankrupt, it is worthless, so you give this person back a worthless stock, which cost you essentially nothing, and then you are going to profit that $10. So the most that you can possibly do in a short sale is double your money. But short selling is also a little bit dangerous because when you are purchasing a stock that you think is going to go up in value, let's say you invest $10,000 in a particular company and that company does poorly, the most that you can possibly lose is 100% of your original investment. If that company goes bankrupt, you would have lost your entire $10,000. But if you are shorting that stock for $10,000, theoretically there is no limit to the amount of money that you can lose. So let me give you a somewhat famous example of this. This happened about 5 years ago, but it made its way into the national news. It had a Reddit page devoted to it. It had a GoFundMe page that was created by this particular investor. So basically a guy by the name of Joe Campbell was really thinking that a particular biopharmaceutical company was going to significantly go down in value once they released their quarterly profit statement. So he put out a short in the amount of $37,000. That's quite a bit of money. Now what he wasn't counting on was CEO Martin Schreckle. He was a CEO of a rival pharmaceutical company. He would later become famous himself as being the Pharma Bro. You may have heard about him in the news. He later went to jail. Anyway, at the time he was sort of a big deal and he acquired a majority stakehold in this other company. And the news drove the stock price of this other company up dramatically. So overnight, the stock price of this particular company went up by 800%. So in order to cover this short that he had put out for $37,000, Joe Campbell had to pay well over $300,000. So that's a significant amount of money. This gentleman unfortunately had to liquidate his 401ks. He basically had to sell off everything that he owned in order to cover his positions. So the amount that you can gain in a short situation is going to be limited, but there is no limit to the amount that you could theoretically lose. You can actually lose more money than you actually started off investing with. And therefore, I'm not a big fan of shorting particular stocks. I think it's a little bit risky, but if you feel confident for whatever reason that a particular stock or a particular industry is going to struggle in the future, then this could be a good way for you to capitalize on that and make some money off of it by shorting either this stock or the entire industry. If you found this video useful and if you learned something today, be sure to subscribe, leave a comment down below. It really helps out the YouTube algorithm to help small channels like this grow and put out more educational content to a wider range of audience. Thanks, and I'll see you all again next time.